Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Market volatility, CPI, geopolitics, and liquidity. This video presents a direct informational narration of the source document. All right, let's dive right in. On Wednesday, June 10th, the U.S. market was hit with a double whammy, simultaneously digesting two major market-moving events: the latest U.S. CPI data and escalating tensions over in the Middle East. In today's explainer, we'll be quickly walking through a few key areas. We're looking at the clash between macro data and geopolitics, structural market liquidity drains, the World Cup effect, some crucial tech and AI updates, World Cup stock beneficiaries, and finally, the technical market outlook. Let's get to it. So starting with the clash between macro data and geopolitics. Interestingly, the inflation data we got wasn't actually as bad as anticipated, but unfortunately, geopolitical risks completely overshadowed any positive vibes from that macro data. We saw the Nasdaq completely fail its intraday rebound and just trend lower. Semiconductors, auto manufacturing, and industrial sectors, they took the absolute brunt of the sell-offs. And look at the VIX index. It surged a massive 11.8% today. Volatility really expanded, market confidence took a noticeable hit, price action got highly unstable, and we saw capital rapidly shifting right into a defensive posture. The main catalyst here really stems from a further escalation of conflicts. According to U.S. Central Command, the U.S. military struck multiple Iranian military targets along the southern coast on Tuesday night. We're talking military bases, naval facilities, radar systems, and missile launch installations. This was in direct response to that prior incident where an Iranian drone downed a U.S. helicopter. But what's really got the market spooked is the spread of these targets. We're moving from traditional military sites to civilian infrastructure. Some of Iran's water supply facilities were actually damaged in the conflict. In retaliation, Iran launched strikes against U.S. military bases in Bahrain, Kuwait, and Jordan. Now, while both sides are claiming to just be conducting defensive operations, the market, it's honestly no longer focused on who's at fault. Traders are laser-focused on the real risk of this whole situation just spiraling entirely out of control. And political figures are definitely adding fuel to the fire. Former President Trump publicly stated that very intense military action will be taken against Iran. He claimed the U.S. heavily damaged Iran on Tuesday and will launch a new round of strikes on Wednesday. At the same time, Fox News revealed that the Biden administration is reportedly close to approving strike plans targeting critical infrastructure, things like Iranian power plants and bridges. On the other side, the Iranian military sent a very strong signal, stating they are reevaluating negotiations with the U.S. and warning that future responses will far exceed previous levels. So as market anxiety over this deteriorating Middle East situation fermented, we saw Nasdaq futures just drop over 1.7% in pre-market trading. Right in the middle of all this tense atmosphere, the U.S. May CPI data drops. And you know what? It presented a report that was actually slightly better than market expectations. Yes, overall inflation accelerated, but core CPI, which remember excludes the volatile food and energy sectors, was surprisingly moderate. The month-over-month growth rate actually decelerated from the previous 0.4% down to 0.2%, beating the expected 0.3%. Meanwhile, the year-over-year growth rate slightly cooled to 2.9%, which was right in line with expectations. Right after that data release, traders immediately started dialing back those extreme bets on rate hikes before year-end. U.S. Treasury yields took a quick short-term dive, and Nasdaq futures experienced this rapid upward spike. At first, the market really processed the CPI print as a positive catalyst, or at the very least, an excuse for a relief rally. The Nasdaq even managed to briefly turn positive right after the open. But man, that CPI-driven rally was incredibly short-lived. We're talking less than an hour before it was just entirely engulfed by the erupting Middle East geopolitical crisis. Market participants were really fearing further Iranian conflict overnight, and that was heavily compounded by those statements regarding severe strikes planned for the day. So by 10:30 a.m., literally any bullish momentum had completely faded out, and the indices completely reversed course to turn negative once again. Looking at this from a technical perspective, the S&P 500 effectively erased almost all of the previous day's recover losses. We saw a bearish body completely engulf the lower shadow, and while it hasn't technically broken below the previous day's low just yet, it is getting uncomfortably close. That closing candlestick indicates some very heavy overhead pressure, which strongly suggests a high probability of the market pulling back even further to go test that 50-day moving average. To give you an idea of where we might be heading, Barclays notes that calculating from the early June high, the total magnitude of this current correction is projected to be somewhere between 6% and 7%. They're estimating a bottom landing between 7,150 and 7,500 points. Now, if that assessment holds true, the market may have only completed about half of its adjustment so far. But remember, the US market doesn't just decline in a perfectly straight line. Actually, historically, the most violent single-day rebounds tend to happen right during these kinds of downtrends. That said, the short to medium-term outlook is highly likely to remain broadly weak. Okay, let's shift gears a bit. Because beyond the macro and geopolitical headwinds, there's a deeper structural reason for this recent market decline, and it's a severe liquidity drain caused by Wall Street's continuous capital extraction across both primary and secondary markets. The absolute most critical variable in this mix right now, that would be the highly anticipated mega IPO of SpaceX, which is scheduled for this Friday. Here's how this works mechanically. Historically, right before the listing of these superstar companies, the market goes through a mechanical capital rebalancing. It's pretty straightforward. Total liquidity is finite. If hundreds of billions of dollars need to be rapidly allocated over to SpaceX, well, that capital has to come from somewhere, right? It must be extracted from existing heavyweight stocks and crowded trades. And the Magnificent Seven, which basically act as the largest liquidity pool in the US market, have been seeing some very visible and sustained pressure recently as institutions make room for this massive new entrant. Let's put this into perspective. Calculations from index rebalancing forecasters suggest that because the NASDAQ, MSCI, and Russell indices might rapidly include SpaceX, index funds could mechanically absorb roughly 30% of SpaceX's tradable float within just 15 trading days. That is a massive move. So first, a lot of institutions are out there proactively selling down the NASDAQ 100 to release liquidity and basically clear some space. If they didn't, forcing a mega-cap inclusion while the index is sitting at all-time highs could literally risk a collapse of the entire valuation framework. Under this localized liquidity vacuum effect, mega-caps like Tesla, Nvidia, and Amazon, along with those highly crowded allocations in AI and semiconductors, are collectively just bleeding capital. So this recent tech stock correction, it's not just a simple panic sell-off. It's Wall Street structurally preparing the ground for the SpaceX listing. And against this already intense backdrop of extreme liquidity compression, secondary market capital raising is only exacerbating the situation. We've got Alphabet and Meta issuing and selling equity, and space-related stocks continually launching secondary offerings. But a huge direct catalyst today was SMCI's massive 28% stock plunge. That was triggered by the company's announcement of a jaw-dropping $7 billion equity and equity-linked financing plan. This includes a $5 billion underwritten offering, plus a $2 billion at-the-market program that allows for flexible, periodic sales of common stock. Now, SMCI management tried to ease concerns, claiming this capital raise is strictly for component procurement to fulfill a whopping $39 billion in AI orders. But let's be real, executing that level of massive dilution in our current high interest rate, liquidity-drained environment, it predictably triggered some incredibly fierce market resistance against such an aggressive capital raise. Oh, and adding to all of this liquidity drain is a really fascinating behavioral quirk, the World Cup curse. The tournament actually opens tomorrow, and if you look at the statistical data, global stock markets tend to consistently underperform during the event. In fact, they've averaged a 1.8% decline over the past 8 World Cups. To put that into perspective, the absolute largest drop actually occurred back during the 1994 World Cup, which was hosted right here in the United States. During that tournament, there was a 50% probability of a U.S. market decline, with the average drop hitting 3.09%. Analysts attribute this anomaly to domestic consumers simply diverting their capital and attention away from the stock market and pouring it into sports betting, dining, and travel. So as you can see, we have multiple converging factors driving this recent continuous market correction. While on the surface it really appears driven by political figures posting about strikes on Iran, those statements are really just capitalizing on the existing momentum to further pressure the market and exacerbate the panic sentiment. Let's move over to some corporate earnings updates. Oracle reported its Q4 results post-market today, and the headline numbers looked solid. Quarterly revenue grew 20% year over year, and adjusted EPS reached $2.11, which was up 24% year over year and actually beat expectations. On top of that, their remaining performance obligations expanded from $55.3 billion up to a record $63.8 billion. However, the details paint a slightly different picture. Oracle's free cash flow is surprisingly projected to be negative until 2030. Furthermore, total cloud revenue came in at $9.9 billion, missing the $10 billion expectation, and software revenue also fell slightly short. This caused the stock to trend lower after some extremely volatile post-market action. You see, with the broader sell-off creating some very attractive valuations across numerous equities right now, Oracle is facing heavy competition for capital allocation, And we're seeing capital similarly abandoning these speculative concept stocks that just lack fundamental backing. Take the Amazon-supported nuclear company XNLG, for example. It peaked right at its IPO and has continuously declined since, eventually breaking well below its $23 issue price. The takeaway here is that in a tightening liquidity environment, power concept stocks that rely solely on flashy presentations are facing collective liquidation. They're going to need a return of abundant liquidity and positive market sentiment before they stabilize. Now, over in the semiconductor space, SK Hynix announced back in March that it had confidentially filed for a U.S. listing, floating a possible IPO as early as August. The important date to circle here is that the SEC might actually approve SK Hynix's American Depository Receipt application during the week of June 22nd. If SK Hynix does complete this U.S. listing, it's going to exert some severe valuation and capital diversion pressure on the existing U.S. AI storage leaders, particularly Western Digital. Keep in mind, Western Digital currently commands a massive AI storage premium with valuations exceeding 5 times. The catch is that SK Hynix offers higher purity in HBM and high-end AI storage. Once that ADR lands, U.S. domestic institutions and pensions, who were previously restricted from purchasing Korean stocks, will almost certainly start selling their holdings in Western Digital and Micron to allocate capital over to SK Hynix. Investors really need to monitor that June 22nd timeline closely. Meanwhile, on a related note, TSMC dropped 4.5% today, and this was despite absolutely flawless fundamentals. The company reported phenomenal May revenue of $13.2 billion. That's up 30% year over year, and analysts project Q2 sales will grow 35%. TSMC maintains a highly optimistic outlook on global AI chip demand, and even raised their full-year sales guidance back in April. So, their stocks declined today? That was purely a result of being dragged down by the broader market. Now, the sole equities actively defying today's dismal market were actually the World Cup concept stocks. DraftKings, ticker DKNG, had a great day, rallying 4.35% right against the trend. DraftKings has very strong platform data, and when you combine that with this impending 6-week sports betting feast, it makes the stock a core short-term catalyst for institutions like Deutsche Bank. The stock even surged 9% in early trading before facing that broader market drag, but it remains really well positioned to potentially challenge its 3-year moving average. Similarly, as a primary World Cup sponsor, the traditional consumer giant Coca-Cola saw its stock rise 2.77% today, actually hitting an all-time high. A Bank of America report referenced that 1994 U.S.-hosted World Cup, noting that the boost to beverage demand historically extends well beyond just the tournament month. They expect early distributor stockpiling combined with post-event restocking to heavily drive demand from May all the way through August, potentially lifting overall U.S. retail sales growth by about 0.3% in June alone. So, what's the big takeaway here? Well, the certainty and cash flow defensive properties provided by physical consumption and betting have truly become the last safe havens in today's U.S. market, potentially sparking some localized rallies. Leading up to next week's Federal Reserve meeting, the U.S. market is highly likely to maintain this pattern of high volatility and low confidence. True risk repricing will probably have to wait until after that Fed meeting. Therefore, any upward movements we see before then should really be viewed as oversold bounces, rather than true trend reversals. The market is still largely expected to see an oversold bounce near the 50-day moving average, which makes excessive shorting at current levels highly risky. So we leave you with this thought. Will the Federal Reserve meeting trigger the final risk repricing, or will the 50-day moving average provide the expected oversold bounce?